Most people assume that when a company needs serious money, it has to go public. In reality, many startups raise millions of dollars long before an IPO ever enters the conversation. Some never go public at all. Instead, they use private capital markets, strategic investors, and alternative fundraising methods to finance growth while staying privately held. At the earliest stage, many startups begin by bootstrapping, meaning the founders use their own savings or early revenue to build the company. This does not usually produce millions right away, but it helps create traction. Once a startup can show product development, customer interest, or early revenue, it becomes more attractive to outside investors. At this point, many startups turn to Reg D private offerings, one of the most common ways to raise capital without going public. Reg D allows companies to raise money from accredited investors without completing the full registration process required for public offerings, reducing cost, time, and regulatory burden. Under Reg D, startups typically rely on exemptions like Rule 506B or 506C. While these offerings are not registered with the U.S. Securities and Exchange Commission in the same way as public securities, companies are still required to file Form D, a notice that provides key details about the offering, including funds raised, investor types, and company information. The scale of this activity shows how critical private markets are. In 2025 alone, there were over 30,000 Reg D filings. These numbers highlight how thousands of startups raise significant capital each year without going public. The next common step is funding from friends and family. In this stage, founders raise money from people they know personally who believe in their vision. These investments are often smaller, but they can give a startup the capital it needs to launch a product, hire a small team, or enter the market. After that, many startups turn to angel investors. These are high net worth individuals who invest their own money into promising young companies. Angel investors often provide not only cash, but also mentorship, industry contacts, and credibility. A startup with a strong idea, capable founding team, and market opportunity can raise substantial early-stage capital from angels, sometimes in the hundreds of thousands or even millions. When a company begins to scale, venture capital becomes one of the most important ways to raise large sums without going public. Venture capital firms pool money from institutional and wealthy investors and then invest it in startups with high growth potential. In exchange, they receive equity, meaning ownership in the company. Venture funding often happens in stages such as seed, Series A, Series B, and beyond. Some of the most successful companies today were built through venture funding long before they ever considered going public. Uber raised billions in private capital from firms like Benchmark Capital and SoftBank to scale globally. Similarly, Airbnb secured early backing from Sequoia Capital and Andreessen Horowitz, helping it grow from a small startup into a global hospitality platform. Another major route is private equity and growth equity investment. These investors often enter the market later than venture capital firms and target startups or private companies with proven business models and strong revenue growth. Instead of funding raw ideas, they usually back businesses that are ready to expand into new markets, acquire competitors, or strengthen operations. These deals can be very large and are a major reason some startups stay private for years. Some startups also raise money through convertible notes or safe agreements. These are popular fundraising tools because they allow companies to raise money now while postponing a formal valuation until a later funding round. This makes fundraising faster and simpler, especially for young startups that are still proving their market value. A well-known example of a company using a safe is Dropbox in its early fundraising stages. Before reaching massive scale, Dropbox used convertible-style instruments similar to safes to raise early capital quickly without setting a formal valuation. This allowed the company to bring in investors, focus on product growth, and defer pricing its equity until a later funding round. In recent years, equity crowdfunding has opened another powerful path for startups to raise capital without going public. Through regulated online platforms, companies can raise money from a large number of everyday investors rather than relying solely on venture capital or angel funding. Some well-known brands have used this approach to do more than simply raise cash. BrewDog's Equity for Punks crowdfunding campaign helped fund the company's expansion while turning customers into shareholders, creating a loyal community deeply invested in the brand's success. That stronger customer-investor connection helped increase brand advocacy, drive repeat purchases, and support BrewDog's rapid growth as it expanded its retail presence and international reach. Strategic partnerships also play a role. A larger company may invest in a startup to gain access to new technology, future acquisition opportunities, or competitive insights. This type of investment can bring both capital and business advantages, such as distribution support or industry validation. The reason startups use these private fundraising channels is simple. Going public is expensive, complex, and heavily regulated. Private fundraising allows founders to access capital, move faster, and often retain more control over timing and strategy. In the end, startups raise millions without going public by combining vision, traction, investor confidence, and the right funding structure. An IPO may be one destination, but for many companies, private capital is what powers the journey. If you want to explore how these deals actually happen in real time, you can access detailed insights on private market activity through SEC Filing Data's Private Offering Real-Time Analytics. You can track active fundraising, understand how companies structure capital raises, and see how startups secure funding without entering public markets.